Hello and welcome along to the Property Academy podcast by Opus Partners. I'm your host, Steve McKnight.
And I'm Andrew Nicol.
And to the show, we've got Tony Alexander back, independent economist, and we're going to be talking about, are we there yet? Are we at the bottom of the market?
And so, Tony, are we? Are we there at the bottom of the market, do you think?
I don't think so. Looking at the results of my latest survey of the real estate agents, they're still not saying that the investors are back in the market. There's still the same net 20% of them saying the first home buyers are in the market, but that's not really changing from sort of the previous month and the month before that. FOMO, it's gone up a little bit from 4% to 7% of agents seeing FOMO, but it's basically zero as far as I can say. The buyers are still aggressively concerned about access to finance, level of interest rates, worries that house prices will fall. So personally, I don't think we are there yet, but I think we're getting reasonably close.
Now, it's really interesting, and bear in mind, we're recording this in May 2023, and so 3 months' time, if you watch this back on YouTube, it might all have changed. What's really interesting is that each property market around the country is slightly different. So Wellington, for instance, if I look at Lower Hutt, I think Lower Hutt house prices are down about 28%. If you look at some places, I think Kaikoura is down almost nothing from the peak of the market. So I imagine that some property markets or some regions of New Zealand might reach the bottom of the market before others. Which ones do you think are going to bottom out first?
Oh, okay, that's a good question. I do a set of graphs where I look at their prices in a region compared with their trend against the country as a whole. And so you're looking at most of the North Island is well, frankly, overpriced, apart from Auckland and Taranaki. South Island didn't really have the same pandemic boom as the North Island, so maybe there's capacity for the South Island. The top of the South Island it's been flattish for a while. I've been interested there. I think, quite frankly, Christchurch, because you've got, the tourism recovery, still the post-pandemic post-earthquake tourism recovery to come along. Affordability is better than a lot of the rest of the country. The students know that, and so the numbers at Canterbury Uni are going up versus falling, most of the other unis around the country. So I think there's capacity for that to happen down here, maybe in Christchurch with some strong economic drivers. But in terms of what goes up first, that's probably not really how I look at things because it's a rabbit hole.
So maybe Auckland, maybe Taranaki, maybe some of Christchurch. I'm surprised you didn't think Wellington might bottom out earlier because Wellington house prices have fallen by such an enormous amount. If you really think about it, Lower Hutt, I think Upper Hutt's not far behind, 28% down, lost over a quarter of your house value on average. What's your read on the Wellington market?
Yeah, no, good comment. It's because I live in Wellington in the countryside there. Maybe I'll just dismiss the thing out of hand. Wellington got well overpriced in late 2021, and I remember in the second half of 21 basically saying, Wellington's in for a big correction whenever the thing does start there. It's had it more than most other parts of the country. The region is about 24% plus down from the peak in late 21. Auckland's only 22%. The rest of the country is less, 16, 17%, or in fact less than that. And I can actually look at some of my indicators in my surveys there of the real estate agents and see a bit more life starting to return to Wellington. The first home buyers are starting to get a bit more active. The thing about Wellington is, am I saying Wellington City or am I talking Wellington Region? Now, there's a bit of a difference here. You see, Wellington Region, you've got basically 5 cities, Wellington City, Lower Hutt, Upper Hutt, Porirua, and Kapiti Coast as well. Wellington City, I think, is more and more challenged in terms of the roading seems to be getting worse and worse. The water system, the network really isn't up to it. Even the mayor disses on Courtney Place as a nighttime entertainment area, etc. Oh, and there's protesters on the road many days of the week as well, trying to stop people getting in there and getting to the airport. There's good growth potential. I've always thought for the Hutt Valley, lower and upper. There's good economic development happening upper Hutt, and there's land available up there for sort of industrial services sector development. There's intensification happening in Lower Hutt, and now they're about to commence the multi-million-dollar lifting of the flood banks, reorientating the city CBD to face towards the Hutt River there. A few buildings and houses are going to get demolished, but there's a big rejigging, new Melling Bridge going in there. If you're looking up at your Porirua, there's a huge rejuvenation of the State House sector that's going on there, as well as massive construction in Kinapuru Drive, the landing across there. Lots of new units have gone in, so there's some rejuvenation. But up the Kapiti Coast, people have already cottoned onto this one, the benefits of the Transmission Gully Expressway going up there, motorway, and then the Expressway North. Lots of economic developments, Kapiti into the Horowhenua, power, and it's a lot of the price. It's already factored into the prices. I've spoken with someone about this recently. So there is an economic development that's happening maybe more north of Wellington City than in the city area itself.
Okay, so perhaps Lower Hutt, Upper Hutt, Kapiti Coast might be somewhere to look at. If we're coming back to the national view of the property market, though, if we're not there at the bottom of the market yet, what's your best guess, or what do you feel in your waters for where when property prices might bottom out?
Yeah, winter. Winter. So that's a 3-month period that we're coming into. I think that's when we are going to bottom out. But whether that means, what's the first month of winter? June?
That'd be July, wouldn't it?
June, July, August, I think. Whether it's June or July or August, whatever, I don't know. Because, of course, there's the economic fundamentals I could talk about of the migration flows, the construction flow coming along, and that's sort of where half of your analysis might be and the drivers of a housing market would be. But then there's more the psychological investment-driven ones. I'm waiting. Is it time to move? Is it time to move? No economic model is going to give you insight into where people, as I say, at some stage go, I've waited long enough. And they realise the booming migration. They realise, oh, the longer-term fixed rates are already down. I guess that means the short ones are going to follow. Well, the answer is yes. Don't know when. And what if at some stage the Reserve Bank in winter goes, she's looking pretty good now. Actually, the outlook for inflation is okay. That will just trigger the market. The interest rates will rally right from that point, and then people start coming in. You can't predict when these things are going to happen, but yeah, that's my best pick. One of the winter months.
And so what are some of the signs that the market is changing?
Oh, okay. Signs that things are changing out there. The pace of monthly decrease in house prices, seasonally adjusted, as measured by the REINZ House Price Index, that slowed down. The fall was only 0.2% seasonally adjusted in March. February was minus 1.1. The average monthly decline since December 2021 has been 1.1%. So maybe that's a little bit of a sign. January and February housing turnover, real estate activity were at record lows. March wasn't. It was still horribly low, but it wasn't as much as a record low there. My monthly survey of residential property investors I do with Crockers, that shows something interesting, that there's a net 13% of investors now saying they're finding it easy to get good tenants. Now that's a turnaround. There's pressure in the rental market. I've got an increase in the proportion saying they're going to look at increasing rents and a rise to 6% of the average rent increase sought from 5.3% back in December. So I look at that as a wee bit of a sign. The fact that we've got the first home buyers, maybe the early movers back in the market from 3 months ago. So some people are out there making purchases, and CoreLogic have good data, maybe the best out there in terms of buyer classification. So I'd recommend people have a look at that. So there's just some early signs there, but I consider them still pretty tentative.
And one thing that I remember you writing in one of your reports was that a couple of years ago, maybe 18 months-ish, the Reserve Bank came out and started producing a measure of whether house prices were sustainable or not. And at the time, it probably surprised no one with the conclusion, hey, they were unsustainable at the peak. And I remember you saying that if they keep releasing this data, eventually, with all of these house price falls, then the Reserve Bank would come out and say that, oh, look, house prices are now sustainable. Now, two things interesting happened over the last couple of weeks. First, Christian Hawkesby, the Deputy Governor of the Reserve Bank, came out and said, hey, property prices now are in line with their medium-term fundamentals, so we're going to ease the LVR restrictions. Then about a week later, they came out again saying, oh no, house prices are still unsustainable. So what do you kind of make of the sounds the Reserve Bank is making in terms of these press releases that are coming out?
Yeah, I'd focus on the first one, because with prices nationwide down 17% from their peak, that they've corrected a long way. And we've got to remember, people's incomes have been rising over the period of time that this has been happening. The equations are changing out there. But I think the Reserve Bank realised, hang on, maybe that guy Tony Alexander, who said he will jump up and down and say, hey, the Reserve Bank's saying the prices are sustainable, will do it. Maybe we're just better offset that one a little bit in the financial stability report, the 6-monthly report there. So I think they thought, okay, no. They might interpret that one too optimistically. Let's just say, oh, there is still a risk that they could fall away strongly. But I'd look at the first comments there.
Do you think the Reserve Bank reads economic reports? Like, let's say they put out some data, you report on it, ANZ, ASB, Westpac, they'll all report on it, and CoreLogic. Do you think they're reading those economic reports to see how what they're saying and how the data is being interpreted? Because, of course, that's going to impact what the media reports on.
Yeah, I think definitely they are reading the information out there. I'd like to think that somebody in the economic department there is having a look at my survey results there because I aim to get coal-face sort of stuff there. So I like to think they're doing that. The problem, however, is they're lost in their marriage to their models. So they've got their models of the economy and they need to make things fit into their models. So the outlook they have, I think, and I think they proved this during the pandemic when they eased too much, they were too driven by what their models show them based on how our economy used to behave in the 2000s, the 2010s, etc. So that's where I think it falls apart. They're too model driven.
And so what are you seeing at the coalface with real estate agents at the moment? What are they reporting?
Yeah, they're still reporting big concerns from the potential buyers about the level of prices falling away, interest rates being high, access to finance. There are still big concerns there. They're not saying the investors are back in the market at all. There's no evidence of any wave of investors selling, but as buyers, they've been out of the market since March 27, 2021.
Do you think those investors that are going to potentially sell are waiting for the election, see what happens, see if we get a change in government, or maybe don't recognise the impact of the deductibility rules yet because they're only 50% through the transition?
Yeah, I think it's the second one. I don't think many are necessarily waiting for the election. It's sort of dangerous. I mean, yeah, if National win, then the rules will change, and I would expect that then to bring investors back in the market. It would be the opposite of what happened in March of 2021. So that would definitely, I think, have an impact if National win and they then change the rules. Not all of them. The ring fencing, they're still going to leave that in place there. But yeah, I still think there's probably a few that haven't had understood what their accountant's saying to them.
Absolutely. Yeah. And now they're getting the bills.
Yeah, and that's right, at a time when interest rates are high. But the interesting thing is, as another year goes by and more realise the interest deductibility change, however, the interest rates will start to maybe come down.
Yes.
And so there's actually going to be a bit of a softening of that impact in the next 2 to 3
years.
But it's still going to hurt. We've got to remember a lot of investors, they pay a lot of cash or they don't need a lot of debt out there. So there's always that big cohort that sits there and they have a long-term focus as well. So and of course, they move towards the new build market as well. So I don't see a decimation of the investor sector out there by any means. And I think the government is just hoping to guide people more towards facilitating the new construction, especially social housing, of which we need just so much in the country.
So what would your advice be for an investor who's trying to buy at the bottom of the market?
Yeah, don't try and get greedy because people do that in the share market. They do it with exchange rates and you end up, sort of chasing your tail on the way up or down, whatever is relevant there. Just remind yourself that your focus is undoubtedly on the long term. And you've probably never heard somebody say, oh, I bought my first house back in, I don't know, 1995 and I paid this much, but I wish I'd waited 3 months longer and I would have got it for $15,000 less. In the scheme of time, that gets completely lost in the wash. Keep the long-term focus there, and in that regard, picking the bottom, we economists know we can't do it. Then it really doesn't matter.
And look, if you were to, again, just take a complete stab in the dark, when do you think the market will fully recover back to the November 21 prices?
Oh, okay. So prices up about another 17-20% or so within 3 years. I think easily within 3 years, because there's a big build-up of things at the moment. The listings are going to fall away and become short again. The migration numbers are going to go through the roof. The interest rates are coming down. Construction is falling away. The labour market is tight. There's good job security going on out there. You bring all these things together, and like I say, at some stage, people will realise what's happening, and the buyers will move back in.
And
so there we go.
Happen quite quickly when it happens.
There is a risk that we have a period of relatively rapid price acceleration, especially because there's almost 18 months worth of people queued up just waiting.
That's really interesting because we've been collating all of the forecasts from the banks that release forecasts, the Treasury and the Reserve Bank. Treasury is the most aggressive, thinking that we will fully recover within pretty much 3 years of bottoming out, which is what you're saying. Westpac, they release, I think it's about a 5-year forecast, and they think we'll only get maybe another 10% increase over the next couple of years. So do you follow any of those forecasts very closely from some of the banks?
Zero. Don't look at them at all. No. What I learned as a bank economist there, initially at Westpac and the BNZ for 26 and a half years, be your own man. Make your own forecast based on your own analysis. And if you pay a great a lot of attention to what others are saying and doing out there, it will influence your view. So I will certainly be aware of the commentary generally that's coming out, but their actual numerical forecast, no. If I'm going to make a forecast, I want it to be spat out of my own mind. Having said that, I try not to give specific numbers because we've all proved, well, even before the GFC, the economic models don't work any longer. The shocks to our economies, our societies are more frequent and maybe deeper than they were in the past as well. And that's why, certainly from the property investment point of view, keep the long-term focus and stay the course. And just be aware that you will be scared now and then by rogue forecasts of horror and the media scaring you away. Sort of maintain that long-term focus and just wend your way through the uncertainty as it comes along.
Right, let's wrap it up there. But the good news is we've got 2 more episodes of Tony with us over the next couple of days. If you're watching on YouTube, go and check out your favourite podcast listening app because Tony is going to be joining us for another 2 episodes. We're going to wrap it up there, but please don't forget to rate, review and subscribe to the podcast. It really does help us get the message out to more people. Thanks for listening to the Property Academy podcast. I'm your host, Steve McKnight.
I'm Andrew Nicol.
We're going to be back again tomorrow with even more daily strategies, tactics and insights to help you get the most out of the New Zealand property market. Until next time.